invest in mutual funds and stay invested for the long term. But when I talk about all these Gen Zs and millennials, they have that anxiety either to get their money out after having a handsome profit, or when the money is doing nothing, the return is really stagnant, they have that anxiety to take that money out or rather invest in some stocks or some other asset classes like cryptos maybe, who can give them better returns. So on to the mutual fund investing. Advise the viewers that what is the ideal amount or the ideal time that where they should stay invested.
Hi, Shrishti. Good evening. I completely concur that this is a very, very interesting topic. What's long term? Because short term and long term are English words. If you can actually transform them into mathematical guiding principles, it becomes relatively simpler for a lay investor. Point one, I think we have to bifurcate this question into two parts. Now, of course, one size doesn't fit all. Having said which, there are several factors which will decide the period. It could be the financial goals, it could be the risk tolerance, it could be the investment horizon, market conditions. Several things actually influence a holding period or ideal holding period, and it's not one size fits all. The personal in the statement personal finance is the individuality of the current status of a specific investment. Having said which, one thing as a matter of principle, everybody should try and incorporate if that makes sense to the viewer. In my opinion, that's the most important fundamental principle when you're doing investing, is equity needs very long. There's a difference between the time frame of long term for equity and the scheme. Now, for example, I would want to give equity 20 years to invest, but not every scheme, equity mutual fund scheme, 20 years. What am I trying to make a point is that over the last 9.5 years, we have been running a model portfolio. We have bought 38 schemes, sold 37 schemes in the model portfolio, and beaten Nifty by about 3.23. If I just bought the same schemes which I bought 9.5 years back and didn't make any changes, every 10 crore investor of ours would have been poorer by 2.5 crores. So point I'm trying to make is give equity, which is the asset class long term, need not necessarily give the same benefit to each scheme. Schemes require a complete, thorough, zero-based evaluation every 2 years, and equity needs eternity as an investing time frame. So long term is forever till you need the money, and minimum is 8 to 10 years.
Okay, minimum time is 8 to 10 years. But Feroze, when it comes to taxation, guide us for a viewer, what does this mean? Because in terms of the taxation, there are two factors at play. Firstly, short-term tax, and the other one is long-term tax. And in that as well, there's a difference between equity as well as debt investing. So whenever anybody who is wishing to stay invested for long-term, how will taxation make a difference there?
I'd like to take a minute in terms of drawing up the context, because I think taxation is one of the most important things an investor needs to comprehend, and not just today's taxation, the envisaged taxation 2 years from now, 5 years from now. What would taxation look like? See, it's because tax rules are of not the investment date. When you redeem, is whatever the applicable tax rules will be applicable on your money. You may think that you're going to pay 10% tax on equity. If the law changes and you are having to pay 15%, you will have to pay 15%. So it's not just important to understand the current taxation, also understand what is the ministry thinking. And every government gives you clear signs of where is it headed. What am I trying to say is India is looking at tax regimes becoming simple on every count. Income tax is becoming simple. There's a second method which has very, very clean, no exemptions. Corporate tax has been simplified. Capital gain tax is still waiting to be simplified, and it is funnily complex. Which is a long-term asset, becomes long-term in 12 months. Debt, which is from an investor standpoint, money you keep for short terms, becomes long-term in 3 years. And real estate becomes long-term in 2 years. It's just the opposite of how it should be. So I think capital gain tax will be simplified in the country. And I think like other top five global economies, they have very, very simple tax. All asset classes have the same taxation in most of the economies above us in terms of size. Now coming to what's the taxation in the current regime is more than 12 years, equity mutual funds become long-term, or any equity asset class which is listed becomes long-term in 12 months. Unlisted equity becomes long-term in 2 years. Debt funds, which is a more retail instrument, becomes long-term in 3 years, provided they have one third in equity. One third in equity is a new rule which happened when the finance bill became an act on 26th of March this year. Debt funds now don't become long term at all if they are purchased after 1st of April 2023. This huge change in taxation of debt mutual funds still needs to be sunken, and every investor who's putting money in debt now has to believe in the new rules and pay taxes as per the new rules. So debt funds will never become long term even after a 10-year holding period. That's the Section 50A inclusion which I'm referring to in this finance bill, which became an act in the parliament lately.
Okay, Feroze, thank you so much for that understanding, and I really like the term that you used for LTCG, and I hope that as per your wish, the government takes steps in that direction. But whenever somebody is investing in mutual funds, Feroze, people are advised that they should have a goal before they step into this investing world. So tell us, as per the investor's goal, what should be how should they decide rather for their investment horizon, in view their investment goals? How should they try to get these lines in a parallel direction?
Yes, Shrishti, I think goals are very important. In any step of life, you will have goals, right? Why should there be no goals in something as critical as money, right? When you're actually going from point A to point B, you use Google Map, right? Would it give you any directions if you don't put the destination which you choose to achieve? So without a goal, if Google Map is useless, is it not? And there are several such analogies which I can draw up in every walk of life. We use some degree of objectives, which is what we wish to achieve. So in money, it's very important to put a goal. If you put a goal, you know whether you're going at the right pace to reach at the right time. That's point one. Point two, if you put a goal, discipline is a byproduct of goals. If you know you're saving for your child's education, then don't you think your commitment to making that monthly installment becomes that much more, because you have internalized that this is money kept aside for my son or daughter's education. What more important in life could it be than giving good education to your next generation? So goals bring in discipline. Goals bring in clarity, whether you're on the path at the right pace. That's two. Now that you have goals, how does transform those goals into actions? And when you invest, you need actions emanating from your goal. So what would I do is, let's assume I have 5 goals, one of them as short as 3 years, another 5 years, another which could be 10, or the last one could be 30 years. I will try and find out what is the weighted average life of all my goals. If I need 5 crores after 30 years, if I need 3 crores after 10 years, a crore after 3 years, I will try and find out, if I put all these goals into one bucket, what is the life of all my goals as a weighted average. Let's assume that is 9 years. That the total goals, if you weight and average it, it comes 9 years. That implies that the asset allocation which I have the flexibility to follow is going to be 60 to 70% in equity. If the weighted average goals life comes to 4 years, then I know I can't go more than 30% in equity, 40% in equity. So that's where the asset allocation strategy can be derived out of the weighted average life of all my goals put together.
Feroze, when it comes to investing, at the very start, what I was referring to, that whenever the return is actually not that significant, then people have that anxiety. Whenever they have good gains, they generally wish to book that and rather invest in some other asset class. But whenever they are at loss, they stick to investing. They just hope for a recovery in terms of their portfolio can bounce back, or rather they can just take out their money when it is at no profit, no loss situation. So for all those viewers, as per your experience, tell us what red flags they should actually be looking at, and at what point in time they should really try to take out their money to help our viewers have an understanding on this.
Yes, Trishti, see, you're absolutely right. This is exactly what happens in the practical world. When there are profits, people want to book the profits and go into something which can be at a higher pace. There is a set of people like that. There is another set of people, when they see negative, they redeem lock, stock, barrel and lose all hope. Either way, you're not right. Point is that investing is both a game of heart and the mind. If you don't bring in a balance between these two, irrational actions are going to happen. You're going to be chasing your own tail. Now coming to the action of what one should do, if equities are down, be rest assured that you don't have to worry. Look at math, and math will give you the confidence to carry on. Now, markets every year have fallen 14.3% every single year for the last 22 years as an average. And if you remove those 2 years, which is the exaggerated years of the global financial crisis and the COVID, usko chhod ke, we have an average fall of 15% every single year. And still investors are surprised when the market falls. I was just speaking to an investor yesterday. He says, market kyun giri thi? Right? How does it matter? It falls every time. You have to decide what you have to do. So point is, please always have hope that markets have fallen every year. And today we are sitting at almost the peak levels. So it doesn't go down unilaterally, becoming zero. Stop believing that. Even if COVID could recover, when almost all of them were sitting at home, all of us were sitting at home, and if it can overcome such an adversity and still come back 76% the subsequent year after FY20, why would you believe that it is only one way down? So don't ever remove equity on the lower side. Now, on the higher side, you may want to choose to change your schemes, but don't leave equity as an asset class. If you're in India, by design, we are fortunate because you're in a country which is the fastest growing economy because the rest of them have slowed down, right? And over the next 10 years, we will still be in one of the fastest growing economies. So it's good fortune. By chance, we live in a country which is the fastest growing economy. So why would you sell equity irrespective of the past performance being higher? This is what would be my suggestion to even the ultra HNIs of the people whom we interact with.
One red flag that investors should be concerned about is over concentration in a single category, or rather AMC. Tell us more on this one, your thoughts with this particular, so that they don't put all their eggs in one basket. How should they decide in terms of the bifurcation of their portfolio? Your thoughts on the same.
Yes, you're absolutely right. What happens is people concentrate on larger monies in one scheme, or a lot of schemes of the same AMC, or a lot of schemes of the same category. So this concentration could be a three-leg concentration. Don't concentrate your money beyond 7, 8, 10% in one scheme. This is mathematically provable that you don't need to put 25% of your money in one scheme. Second, unless you just have 2,000 rupees to invest and you're putting it in two schemes, so you have 50% in one, you have 50%. I'm speaking about a reasonable investor who's invested for 3-4 years, invest 10,000 rupees in SIP, try and keep 8 schemes, which makes it 12% per scheme. That's one. Second, don't be under the habit of going to your bank and the same banker recommending you their own mutual funds, 5 schemes. This is something which is very prevalent that if you see that a guy is dealing with one private sector bank, all the schemes of the same mutual fund of the sister company become a part of the book. Thirdly, there are 8 very good categories which SEBI carved out in 2018. Don't put all your money into flexi caps, 4 flexi caps. That's a wrong strategy. You try and identify which are the categories and I have one scheme each. So because each fund manager is different, each category's banat is different, objective is different. So these are the 3 legs of concentration which you would like to be conscious and in turn avoid.
Well, thank you so much, Feroze, for helping us understand, or helping our viewers understand, what should be the ideal investment horizon for your mutual fund schemes.